Hello and welcome. I'm Andrew Howard, Chief Investment Officer here at Catholic Super, and I'd like to welcome you to this investment update where we'll focus on the extraordinary events that have been unfolding globally since President Trump announced his new trade policy. On April 2nd, President Trump signed an executive order which effectively imposed a minimum 10% tariff on all US imports, and an even higher level for a raft of countries. Since then, we've experienced one of the most volatile periods in share markets for many years, which has only been exceeded by the global financial crisis and COVID-19 market crashes. Equity markets went into freefall, with the S&P 500 index down over 12% in the following 4 trading sessions post the announcement. This resulted in Trump somewhat backing down on the previously announced reciprocal tariffs by announcing a 90-day pause, with the only country to miss out being China. Whilst the White House has signalled many countries are looking to reach a deal with the US, the world's 2 largest economies are now in a tit-for-tat trade war, with the US imposing tariffs of at least 145% on all Chinese imports. China immediately reciprocated by imposing tariffs of 125% on all US imports. The US bond market has also not been immune from the negative sentiment that gripped investors, with the US 10-year bond yield rising sharply in the week following the initial tariff announcements. In addition, we've seen the US dollar lose ground against most other major currencies. This broad-based exit from US domiciled assets is arguably a direct result of investors having increased uncertainty on the direction of US policy, leading to the notion of the US as a safe haven being challenged. The key question that cannot yet be answered is what impact the tariffs will have on the US economy. Consensus is that it will lead to slower growth and higher inflation, but whether this turns out to be transitory or something stickier is clearly not yet known. If the 10% universal tariffs are implemented, then the expectation is that the impact on the US economy will be more muted. But if the more significant tariff levels aimed at some countries are maintained, then the risk of a recession in the US will increase. While some remain hopeful that the US Federal Reserve will be able to continue on its trajectory of rate cuts, the Fed has made it clear that they will wait for greater clarity before considering any adjustments to its policy stance. At this stage, economic data in the US remains robust. However, we expect this to weaken as the intensifying trade war has already dampened the leading indicators of consumer and business confidence. We expect that to translate into weaker economic growth and company profits this year. Tariff announcements, changes and backflips are happening daily, which is making for a challenging market environment and is harming investor confidence. The wild movements we're seeing play out in both equity and bond markets could well continue for some time yet. We're continually monitoring all these developments closely, which includes not only looking at high-level global macroeconomic impacts, but also assessing how individual companies may be impacted. We're very mindful that timing the tops and bottoms in markets is extremely difficult, especially with volatility at extreme levels. We avoid being reactive to the short-term noise and volatility in the market, but more importantly look through the lens of what the implications might be over a medium to long-term time frame. Consistent with what we've communicated previously, it is in times of extreme uncertainty like we're currently experiencing that we're reminded of the importance of adhering to our investment approach in maintaining a well-diversified portfolio. Importantly, the investment strategy we have in place today is designed to manage through a range of market environments and is tested in terms of its robustness through a range of stress scenarios. Our disciplined approach has delivered strong returns for our members over numerous market cycles. So while no one likes to see periods of negative performance, we believe that the portfolio we have in place today is well positioned to weather this period of heightened uncertainty and volatility. It's important to remember that super is a long-term investment, and historically, markets have recovered after periods of volatility. Switching your investment options at a low point in the market turns a loss on paper into a real loss and removes the potential for your investments to benefit from any recovery. You can always talk to our advice team about your specific circumstances and what might be best for you. If you'd like to find out more information, including the latest quarterly investment returns, please head to our website. Thank you for watching.